Do you want to know how to find undervalued stocks? Then I want you to stick around till the end of this conversation. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about how to find undervalued stocks. And this is an important element here because a lot of investors are looking forward to growing their portfolio. They're looking forward to increasing the ROI of their portfolio. And there are many competing investment theories about how to find the best investments based on your time frame, risk tolerance, and specific objectives. One approach, dating back at least to Benjamin Graham's 1949 book, The Intelligent Investor, is to identify undervalued stocks that, for one reason or another, are selling at prices far below their underlying values. To find undervalued stocks, you need to have tools, you need to have systems, you need to have algorithms, you need to have processes that helps you. Nowadays, there are free online tools that provide investors with the ability to search and screen investment ideas within seconds. You can start with a stock screener such as Yahoo Finance or Trading Stocks, and you can even go. There are even specific apps. You can even go to your brokers, and the platform, your brokerage platform, has tools and systems that will allow you to find undervalued stocks. Now, it's easier said than done. In other words, what are the metrics? What are the criteria? What are the tools that will allow you to find undervalued stock? You can actually, besides Yahoo Stock Screener, you also have Google Stock Screener. Now, personally, I think that Yahoo Stock Screener is one of the best out there because Google Stock Screener is not really that good, at least in my view and in the opinion of the whole team. We have tested Google Stock Screener, and I think Google hasn't really invested a lot in that part of the business. So you have Yahoo Stock Screener and CNBC as well as Bloomberg. Those offer, and if you want to go into apps, you want to go with Robinhood and M1 Finance, they offer more in-depth search capabilities. And if you don't mind paying a few bucks every month, you can use Y-Chart's Stock Screener. Now, if you already have a brokerage account, a traditional brokerage account, I'm talking here about if you have an account with the likes of Franklin Templeton, Charles Schwab, TD Ameritrade, JP Morgan Chase brokerage account, then or Fidelity, then I would recommend using one of their screeners. With this, what these tools do is analyze the financial metrics of thousands of companies and deliver to you the ones that meet your input. Let me give you an example. Let's say if your input PE must be lower than 15, the screeners will not show you any companies with PE ratios higher than 15. So, how do you find undervalued stock indicators? And I'm going to go through about 6 or 7 or 8. I'm going to give you a few of them that really are pretty good. They have proven to be true in the last 30 years or even 50 years. And you choose the one that sort of fits your trading approach. There are 6 criteria, actually not 8, 6. We found 8, but I think that the 6 that I'm going to give you are they're pretty good. They're pretty excellent across the board. The first one is you want to have a low price earnings ratio. So price to earnings ratio, PE ratio. So no discussion of stock prices will be complete without referencing one of the most common, but not always the best measures of a stock's relative value, the PE ratio. So every company has a PE. Every publicly traded company has a PE. So the higher the PE, the higher the price of the stock relative to the earnings. In this case, I'm talking about profit. So while a relatively low PE ratio may indicate a buying opportunity, it's critical though, folks, to remember there is likely a reason for the low PE in the first place. For example, let's say a company might report high earnings, but professional investors who happen to follow the business closely may know that the company isn't telling the whole truth. So as a result, the stock price will remain low and the PE ratio will look appealing. So these scenarios, however, are pretty rare, but you should be okay to rely on the PE ratio to find deals. So number one, low PE ratio. If you are looking for undervalued stocks, look for companies that have a low PE ratio. Number two, lagging relative price performance. So let's say a company's share price is lower than those of its industry peers. This may reveal an underperformance situation. In other words, they are not pulling their fair share of the effort here. So the market is just kind of penalizing them by assigning a lower price to the company. This could happen for several reasons. One example is if stock analysts show concern over certain financial metrics, like the one I'm going to talk about soon. It's not unusual for a single voice on the Bloomberg channel, or on CNBC, or in the Wall Street Journal to cause a whiplash effect as investors sell off and drive the price down. We live in an era where investors tend to listen to, influencers. When you hear the term social media influencers, you only think about Facebook or Twitter, but we also have Wall Street influencers, people whose voice carries weight when it comes to picking or ditching stocks. So what happens is investors drive the price too far down to the point of making the stock price undervalued. So in the screener you use, whether it is your own brokerage screener or Yahoo Finance or Google or CNBC or Bloomberg, there will be an option to compare individual stock price histories over various periods against other individual stocks and against stock indexes. All right, I'll be right back right after this. Do not go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are still having a conversation here around how to find undervalued stocks. So I have spoken to you earlier about the fact that you need tools. You need tools to find undervalued stocks. So it could be software, it could be an app, it could be the brokerage platform where you have an account. Now I'm giving you undervalued stock indicators. What are the metrics you can use to determine which stock is undervalued? So the first two are low price earnings to ratio, low PE ratio. Number two, lagging relative price performance. Number three, low price earnings growth ratio, the PEG ratio. We've talked about the PEG ratio in other shows, but here I want to just say that I want just to remind you that the PEG ratio, the price earnings growth ratio, is considered more accurate than just a company's PE alone. When you're looking at a stock, you want to take the PE ratio and divide by the earnings growth rate. So if the ratio is less than 1, in other words, a PE, for example, a PE of 10 and projected growth of 15% will give you a PEG ratio of 0.66. In other words, you divide 10 by 15, right? So if you have a ratio that is less than 1, investors may be given more weights to past performance than to future growth opportunities. So be aware that growth projections are just that. However, you want to mix your PEG ratio with other metrics to be able to have a fuller picture of what's really happening within the company in terms of the stock's price, but also in terms of the projection and the share price prospects. The fourth metric you can use to find undervalued stocks is the high dividend yield. You didn't think of looking at the dividend yield, right? But actually, if a company's dividend payment rate exceeds that of its competitors, think about it. This might indicate that the share price has dipped to undervalued status in relation to its dividend payment. If the company is not financially troubled and future dividend payments appear secure, the dividend opportunity can provide returns in the short term, as well as the potential for the stock price to move higher in the future. So if you're using a stock screener, use the dividend yield percentage to find undervalued stock in any given industry. What I'm trying to say here is that if a company's share price is low, but it is able to maintain the dividend yield that it has agreed to with investors, that could mean that the company is financially great. In other words, the balance sheet is fantastic. They have enough liquidity to be able to maintain that dividend yield. Consequently, this is just a timing issue whereby they are undervalued, because very sooner or later investors will catch up to the reality that this company is indeed doing even better than they have thought about previously. So this is a great arbitrage opportunity here to make some good cash. Another metric you have to use to find undervalued stocks is the low market to book ratio, the MB ratio. So a company that has a low market value, in other words, a low total market capitalization as a ratio to book value, which is the total shareholder equity, may present an undervaluation situation. Let me repeat that. So if you have a company that has a low market value, in other words, a low market capitalization as a ratio to book value, the book value here being total shareholder equity, when you have this sort of situation, you may have an undervalued stock. The key is understanding the real value of both tangible assets and intangible assets. So tangible assets are things like buildings, land, cash, equipment, and intangible assets are things like intellectual property, patent, and goodwill. For example, a company that produces and sells toys might also own property. The value of the property the company owns could potentially be worth more than the toy business it operates. So investors might overlook this, and the price of a stock will not reflect the underlying value of assets the toy company has on the books. When I talk about market capitalization, you have to understand that sometimes you hear the terms small cap, mid cap, and large cap. Small cap means that a company has a market capitalization of that ranges between 300 million and 2 billion. Mid cap means the company's market capitalization ranges from 2 billion to 10 billion, and anything above 10 billion in terms of market capitalization, that's called a large cap or blue chip, if you will. The last metric you want to think about when it comes to finding undervalued stocks is something called free cash flow. So many investors, and that's not just in the United States, we have this also in other parts of the developed world, in Japan, in the UK, and Canada. Many investors put less emphasis on reported profits and more on free cash flow. Free cash flow is simply the amount of cash generated by the business after all expenses are accounted for. So a stock that appears to show low priced valuation because of lower reporting earnings may be a great deal in terms of cash flow. So you can find this from inside a screener or through your brokerage firm by you want to look for the cash/share ratio. So this can be a fascinating experience to see how two apple-to-apple companies differ in terms of cash on the books. So you have two companies in the same industry. They probably have similar metrics in terms of fundamental analysis, but when it comes to cash, you see it's day and night. You have one company having an enormous amount of cash on the books, and the other company is scraping by, is literally going to financiers, either equity holders or lenders, to get some cash. So free cash flow is a great opportunity to decipher which is which when it comes to undervalued or overvalued stocks. So, folks, the bottom line here is what? The bottom line here is that I've given you 6 metrics, right? I've given you free cash flow, low market to book ratio, high dividend yield, low price earnings growth ratio. We also have low price earnings ratio and lagging relative price performance. Those are the 6 metrics you can use to find undervalued stock. Of course, undervalued stocks, of course, you need to have the tool, and the tool can be it can be a stock screener on Yahoo Finance or Bloomberg Finance or CNBC or other financial platforms, or more readily on your brokerage account. Having said that, I just want to say one thing is very important. These 6 metrics are not the be all and all to determine if a stock is a good value. So no single metric or measure can ensure an investor that a potential investment is undervalued. So if several of these seem to be confirming an undervaluation situation, however, you may have identified a market inefficiency that is a good investment opportunity. This is what I was talking about earlier when I mentioned the word arbitrage. So if you see some kind of dichotomy, some kind of disconnect between between the current market price and what your analysis is telling you in terms of undervaluation or overvaluation, then you know there is a good opportunity either to sell if you have an overvalued stock in terms of your metrics, or to buy if you have an undervaluation situation. At the end of the day, it's all about diversifying your stock portfolio. It's all about making sure that whatever move you make, you're able to fit that move into your risk profile. In other words, you're not buying stocks that they're highly volatile if you're more of a risk averse person, or you're not buying stocks that are too slow, too lethargic, in my view, if you are some kind of risk taker. So make sure that your risk profile, your investment horizon, and most importantly, your liquidity situation match the kind of stock you're adding to your portfolio, whether it is undervalued or just regularly valued. In other words, you're just buying it at the market and not doing any kind of a preliminary analysis. All right, folks, thank you so much for today's conversation. I really appreciate it. I appreciate that you have been with us for the last 10, 15, 20 minutes. I really appreciate it. If you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so we can inform you in real time whenever we drop a new show. And we drop this kind of show, guess what? Every single day, rain or shine. I will see you next time. But until then, remember, stay marvelous.